Let me give you a scenario. You've got two businesses, both making $2 million in revenue, both making the same profit. Business A has $1 million in asset. Business B has $200,000 in assets. Which one would you want to buy? And most business owners can't tell the difference until it's way too late. Now, we've worked with over 2,400 businesses for almost 2 decades. We track real numbers, their profit and loss, their balance sheet, statement of cash flow. And I can tell you for sure that the business owners who know their numbers sleep way better at night. They make better decisions. They make decisions based on data, not on drama. They build businesses that increase in value and in valuation. So what I'm going to go through is 5 critical financial skills that you need to know in your business, particularly if your business is over $2 million. The first thing to understand is that most people are giving their accountants 2 jobs and one of those is yours. And the second thing we're going to go through is to understand that revenue on its own can tell you 2 completely different stories. The third thing we'll go through is why the trend is more important than the actual number. The fourth thing we'll do is the one financial document that most business owners never look at and why it's the ultimate scorecard. And the fifth thing is the document that would have exposed the Lehman Brothers before the GFC, and it's sitting right in your numbers as well. And if you want the financial tools and templates we referenced today, then you can grab them in the links below. This one skill determines how successful you be as an entrepreneur, and it is in sales, it is in marketing, it is in prediction. So your score as an entrepreneur will be dependent on your ability to predict the future. Now I'll say that again. Your entrepreneurial score increases with the length of time that you can accurately predict what's going to happen in your business. So when you first start out, the prediction window is usually pretty close. Yeah, people go in and they go, oh, I don't know what's going to happen in the next month or so. You're just sort of guessing, and that's okay because that's normal. That's at the beginning. But it's like building a muscle. As you build the muscle, you want to be able to extend that further out. And here's how the cycle works. As leaders in your business, managing that business, our job is to make better quality decisions. Now, those decisions create different activities or happen and have different actions. Those activities drive a certain result. And we see these results in the numbers in the business. Now, the skill of turning activities into results, your profit and loss, your balance sheet, your statement of cash flow, that is the job of your accountant. So things like your bank transactions, your invoices, your receivables, producing all the financial documents that showed what actually happened. That's what the accounting or your bookkeeping team will do. And this is a highly crafted skill. It takes years and years and years to be able to do this activity. And here's the thing is most business owners don't appreciate how much effort, how much training goes into doing this really well. But here's where the business owners get it wrong. They pressure their accounting team to give them not just the numbers, but also help them to make different decisions as they go forward. Producing these numbers is a huge important skill. The second part, which is bringing those numbers up here so that you can make better quality decisions, that's the second part. That's a completely different skill. That's not the accountant's job, that's your job. Your accountant tells you what happened. Your job is to decide what happens next. And the skill to be able to read these numbers and make better quality decisions is a skill that's equal to this skill that's over in here. It's not something that should be skipped over. Knowing the numbers and getting the numbers is the first part. The second part is how to interpret and how to read it. Putting it all together is the key part next. So it's your accountant's job to look at the activities and create amazing results in a profit and loss balance sheet, statement of cash flow. It is your job to take those numbers and fully understand what's going on as a leader within the company to make different decisions. That's your job. That's a completely different skill. It's not your accountant's job. That's something that you build over time. It's a muscle that you do, and it doesn't have to be perfect. What's key to understand around that is that you're constantly looking at the numbers and navigating your business based on the numbers. That's how you grow. That's how you scale a business profitably. And that's how you go from reacting in a business, oh my God, what's happening with the cash flow, to truly leading the business. From guessing to actually knowing what's happening. From flying blind, from flying your plane, your jet fighter with the real instruments. Understanding your numbers isn't accounting, it's leadership. So you're a business owner, you now know what the accountant's job. Now I'm going to take you through what your job is, and I take you through the 4 skills that you absolutely need to know to do your job and nail it. If you don't know how to read the scoreboard, you don't know the score, and most owners can't. So with 2 businesses, both are making $2 million. They're making $2 million and have the same profit. Business A has $1 million in assets. And business B has $200,000 in assets. And they generate the same revenue. Which one would you want to buy? Most people will say business A, but the truth is it's actually business B. Because B requires less revenue to achieve the same outcome. And that's asset efficiency. It's one of the most important numbers that most people, most business owners, they never actually look. They never even think to look because they don't even know where to look. But now let me add the extra part to it. Let's just say that the year before, business A was up here, and so they'd come down to this direction here. And business B was down here, and they were coming up onto this direction here. So the question now is, which business would you choose in this situation? It's still business B. So that's another component that most people never look at, is where's the trend? Where is it moving from? Because both these businesses on the surface making the same amount of cash here, one has a different asset base and can deliver a different result, but where have they come from is another critically important piece. When you look at your numbers, what's critical to understand is not just where it is now, but where it's come from. The truth is, most people, when they're looking at it, they look at these, they go, well, they're the same, but they're not even close. And our job as operators of businesses, owners of businesses, to have the smallest asset base that we possibly can to drive the largest revenue and the highest profit that you possibly can. And then for the profit, highest amount of cash flow. And we need to be tracking how this looks, the asset, the revenue, the profit, and also the trend and how it's moving. Not just one single point, which is what most people do. Business owners just get busy and busier and busier. And they get to the end of the year and they go, I don't feel like I've made any progress at all. Then they check their numbers and realize, oh, actually it's been one of the best years I've ever had. Or the opposite. And they go, man, it was one of the worst years I've ever had. The thing is, they feel great all year, but the numbers can tell a very different story. Well, they feel bad all year, and again, the numbers tell a different story. Revenue alone doesn't tell you whether your business is getting stronger. You need to know the efficiency that you can drive that revenue, and you also need to know the direction or the trend that it's moving. 2 businesses, A and B, one is worth buying and one is definitely not. It's a liability. And the difference is in the numbers, and the owners never check. And that brings us to why the trend, not the snapshot, is the number you should be actually watching in your business. When you get to the end of the financial year, or even to the end of the quarter, sometimes you look at where you are right now, and I know people get in there, they'll give themselves an uppercut and they'll beat themselves up. Why shouldn't we be further along? I hear people say, this isn't what I expected. It's not working out the way that I wanted. I'm not feeling like I'm making progress. And that's okay. I hear that all the time. But the thing is, you've got to stop looking at the dot of where you are right now and start looking at what I call the line. What I mean by that line is really, really simple. And that is this. Where were you, if this is now, where were you the year before? Yes, a lot of people compare themselves with other people where they think they should be. What we really want to say is really simply is, where were you the year before? Now, if you were here the year before and you go, I'm here now, that is progress. That's what you want to be mapping. You want to map the trend in the business and not be so focused necessarily on the exact outcome. Map how far you've come rather than looking at actually where you are right now. because the trend over time is what is most important. If you know the trend, then you have a factual pathway that you can follow. So what you want to be looking at is mapping where you're coming from, where you're moving, because the trend is over time is what is most important. It's, yes, the dollar value has a relevance. It's certainly that is important. But just imagine you've got two businesses and they're both at the exact same point. One started here, and let's say the second one started here, and it's coming down to that same point. Question is, where have you come from? That's going to make as bigger impact than anything else. The trend or the line tells the truth, or the more of the story where the truth is. Now, here's research that we've done across thousands of businesses. The most sustainable growth rate of business over a long period of time is between 30 to 40% consistently. That's year on year. Now, that seems to be the pace that breaks the least amount of things in business and that you can sustainably grow it. The pace that actually can handle a business to scale without the wheels falling off. Now, it doesn't mean you have to hit this exactly. It means these are the guide rails that you can follow along. There are phases where you consolidate the business. You've driven hard, you've got more cash in your bucket, you're going, okay, this is good, we're getting to a great place. Then you might step it up to another level. So you go, cool, we'll stay at the lower level, and then we go up to the higher level. That's normal, that's smart. But knowing your trend gives you something a single number will never be able to give you. Once you can see the direction, you can then steer the ship a lot better. A single number tells you where you are at that particular point in time. The trend tells you where you're going. And if you're not tracking the trend, you're navigating without a compass. The snapshot lies, the trend tells the truth. So if the trend tells the truth, which document actually gives you the clearest picture of where your business really stands? And it's not the one that most people look at. If you want help reading your numbers properly and knowing exactly where you are so you could sleep well at night, then all you need to do is book a growth driver call with us, and the link's below. Your balance sheet is the ultimate scorecard for your business. And it's this document that most business owners don't actually look at all. Think of this as like a seesaw. What happens on the left side needs to equal what is on the right side. That's why it's called a balance sheet. The two sides balance. So let's go through. On the left-hand side, you've got things and stuff. What's in things and stuff? You've got cash in bank, you've got accounts receivable, you've got inventory, you've got property, plant, and equipment. These are your assets. You've got depreciation. You've also got amortization, and these are all your things and stuff on the left-hand side. On the right-hand side, you've got two different categories. You've got things that you owe and things that you own. So let's go through the things that you owe. You owe money to suppliers. You owe money to the government, otherwise known as tax or taxes. And then also you might have loans of some sort, either to a bank usually, or it could be a private loan. These are your liabilities. Then there's stuff that you own. Okay, this is the capital that you put in at the very beginning of the business. So put capital, owner's capital. And then what happens if you retain earnings in the business, then you've got your earnings as well. That's your equity in the business. So you've got things and stuff on the left-hand side. You've got things that you owe and what you own. And what's on this side needs to equal this plus this. They must balance. Now, here's what makes the balance sheet so powerful. It's fact. It's not a theory. It's actually what happened. Not what should have happened, but what actually happened. It's like we took a photograph and we took a snapshot in time of where the business really is at. When you print it off and you look at the balance sheet at the top, it will say, as of the date that you printed it, this is the state of play in your business. It's the big picture of the entire business. It summarizes it all in one document. You've got your cash, you got your receivables, you got inventory, all this stuff all in one place. And yet most owners just skip over this entirely, and I don't know why. They constantly look at their what's in their bank balance, or they just look what's in their profit and loss, which is just fiction. which tells you what should have happened, but not what actually happened. They ignore the balance sheet, and that tells you what actually happened. That's like playing a game of football and never looking at the scoreboard and running around all the time, being busy, working hard, putting in effort, but you don't actually know how well you're actually going. Are you winning or are you losing? Your profit and loss is a story. Your balance sheet is the scoreboard of the game that you're playing. And if you're not looking at your scoreboard, you're just guessing. So stop guessing and start reading your ultimate scoreboard in your business. Now, there's one more document that most people miss entirely, and this is the one that could have caught out the Lehman Brothers before the GFC if anyone had been bothered to look at it and it was publicly available. There's a financial document that most business owners have never looked at, and it's the one that would have exposed one of the biggest financial collapses in history before it actually happened. And it's called a statement of cash flow, and it's surprisingly simple. Here's how it works. You start with your beginning cash. How much was in the bank at the start of whatever the period is. Then over a period, three things can happen to your business. The first one is what we call your operating cash flow, or OCF. Now, operating cash flow is cash from the actual operations of your business. You delivered a product, you got paid for it. You paid your expenses, some cash went out of your bank. Did you make or lose cash from running the business over the period of time that you looked at? The second thing is what we call investing cash flow, or ICF. And investing cash flow is if you sold a piece of equipment. So you've got a truck and you sell it, your cash goes up because you sold something in your business. You sold an asset that's in the business. And if you bought something like that truck, then your cash goes down. It's not revenue, it's buying or selling assets. That leads us into the third one, which is financing cash flow, or FCF. It's loans coming in or it's loans being paid off. It's money being injected in or it's being pulled out of the business. The beginning cash plus or minus these three things gives you your ending cash. And that's it. That's simple. Now, here's why this matters though. The Lehman Brothers was one of the largest financial organizations in the entire world before the GFC. And the thing is, they were a public listed company. So their profit and loss and their balance sheet was publicly available. And that, if you looked at it, they were crushing it. Their cash was going up. Everyone was saying things are fine. But if anyone had actually looked at their statement of cash flow, they would have seen a very different story. And the thing is, this was publicly available. You could have gone online and seen it yourself. All Lehman Brothers was doing was selling off their assets. They were selling it off in pieces so they injected cash into the business, so the cash in the business made it look like it was healthy. The operating cash flow, on the other hand, was terrible. It was going down. But because they were selling their assets, the investing cash flow, they were selling it, their cash was pumping up into their business. So the overall number looked like it was fine until there was nothing else to sell. So all you need to do is literally look at one document and that would have told you everything that was going on. Now, this same principle applies to your business. And if you understand what this really is and what's happening in the cash position in your business, you can actually see how cash can be manufactured. And particularly if you're going to sell your business, and especially if you're going to buy a business, this is critically important. This is like the one document you have to look at. And it's probably sitting in your financials right now. You just haven't opened it. So remember what we've gone through. We've gone through the accountant's job and we've gone through your job. We went through the 4 financial skills that you need to be an expert on if you're going to navigate your business. We talked about the 2 types of businesses, same revenue, same profit, one getting stronger and one that is just about to fall apart. The difference wasn't effort. It wasn't strategy. What it was whether the owner could actually implement these 4 financial skills. And if you want help reading your financial numbers and building a business that's generally getting stronger, not just busier, then all you need to do is to book a Growth Driver call with us and we'll support you on that journey. So stop guessing and read the scoreboard and start leading from the numbers. Data over drama.